Hello. Today, we're diving into a topic that's on every homebuyer or homeowner's mind, the ABC of mortgages. We are going to unpack the key differences between A mortgages, B mortgages, and the lesser-known private mortgages. First up, let's talk about three specific factors that can decide which type of mortgage you'll be offered. Consider a three-legged stool where one leg is property, one leg is credit, and one leg is income. If you want to use a traditional A lenders like banks and credit unions, all three legs of the stool must be balanced, meaning that a hot steaming cup of coffee sits nice and stable on the stool. To be A lender qualified. For example, you have a beautiful property that could easily be sold in 90 days if needed. You have good credit with any minor occurrences easily explained. If you're employed, you can produce a minimum and employment letter and a current pay stub. If you're commission-based, you can provide at least 2 years of tax returns showing that you don't owe money to CRA and what income you've earned. If you're self-employed, you can provide at least 2 years of documents showing your gross income, expenses, and net income. But what if your financial history isn't textbook perfect? An alternative B lender would be an option if one of the legs were unstable and the coffee is at the risk of spilling. This may be if the property and credit are in good shape, but you don't have the proper documents to prove income or if taxes have not been paid. In this case, a B lender may be willing to approve you if you provide at least 12 months' worth of bank statements showing some income coming in. A B lender has higher interest rates, but it can be a lifesaver. You can deal with that one wobbly leg and qualify for an A lender in the next 1 to 2 years. Now, what if you're on a different journey altogether? Let's talk about private mortgages. The stool now has 2 wobbly legs. The coffee is definitely going to get spilled. Private mortgages to the rescue. For example, the property isn't up to standard as it's going through a renovation. Your credit score is lower, usually below 600 or 650, depending on the lender, or you don't have all your documents to provide income. A private lender would be the only option. A private lender's rates are higher but are more flexible in terms of eligibility criteria, making them an option for self-employed, real estate investors, and those going through some life events. A private mortgage requires a strategic exit plan in 1 to 2 years, explaining how the other 2 legs on the stool will be fixed. Learn more about your mortgage options. Visit effortlessmortgage.ca